Welcome to Candid Conversations for Financial Markets podcast series. I'm your host, Laura Paglia, President and CEO. Our podcasts are designed to provide insights, transparency, and provocative yet achievable proposals for matters that move financial markets in Canada. Today, we're digging into flow-through shares, a uniquely Canadian financing mechanism at the intersection of tax, policy, capital formation, and resource strategy. We are joined by Geoff Clarke, co-lead of the mining law practice at Miller Thomson, where he advises on corporate securities and capital market matters. Geoff provides practical solutions to leading companies, global businesses, institutional investors, and investment banks with a focus on securities offerings, mergers and acquisitions, corporate governance, shareholder activism, fairness opinions, and continuous disclosure. Prior to joining Miller Thomson, Geoff served as president and director of a full-service institutional investment dealer with offices across Canada. In that role, he provided financial and strategic advice to mining companies and investors on offtake agreements, joint ventures, strategic partnerships, and raising capital. Welcome, Geoff.
Yes, thank you very much. It's a pleasure to be here today.
So we're going to start with an overview of flow-through shares. Could you please walk us through the key features of this security?
Sure. So a flow-through share is a type of common share that's issued by a company known as a principal business corporation. And these are companies whose activities are primarily in the resource sector, such as mining or oil and gas. And as a flow-through share, it allows the principal business corporation to renounce certain exploration and development expenses into the hands of the investor, and the investor is able to deduct the cost up to the full cost of the shares against the investor's personal income. So it's a transfer of expenses where the expenses are incurred by the principal business corporation through mining or oil and gas exploration and development expenses, and those expenses are no longer the expenses of the company. They're renounced, given to the individual, who can then use those as tax deductions.
The companies that use them are primarily small junior mining companies, or are they also used by larger firms in other sectors?
They're primarily the small junior mining companies rather than the larger producing or profitable companies. And the reason for that is that these junior resource companies have no net income. It takes a long time to go from exploration into production. And during that period of time where they have net losses every year, they're not benefiting from those marginal or additional expenses that would be reducing their taxes. Whereas the larger firms, and assuming that they are producing companies with profits, they're benefiting from having their expenses deducted, and so they're less desirable to give away to investors. So the companies that most often use flow-through shares are small junior companies with no profits and no revenues. But they can be used by any principal business corporation.
So currently, flow-through shares are available to resource, mining, oil and gas, forms of renewable energy, but not available to other industries like AI, quantum computing, other technologies, or advanced manufacturing.
That's correct. So there are certainly groups from those other industries that are interested in having their industry or their sector get a flow-through share treatment, but that's quite a gift from the federal government. The federal government would have to decide that those types of companies are also principal business corporations, and that's quite a policy decision for them to make in terms of balancing incentivizing various sectors with the budgets and deficits that the government is running.
Okay. For those firms who currently qualify for flow-through shares. Another innovative Canadian twist is the charitable flow-through structure. So could you explain to us the link to charitable flow-through shares, and how that is materially different from a standard flow-through share?
Yes. So to recap what I said earlier about the standard flow through share is that the initial purchaser of the common shares from the principal business corp is the investor who gets to renounce the expenses that are transferred to them. And then they continue to hold the shares as common shares afterwards, and they're free to continue to invest in them or sell them whenever the resale rules would apply. In a charitable flow through transaction, the corporation would sell their shares to the initial purchaser, who gets the tax deduction, but that initial purchaser would only hold those flow through shares or common shares for a very brief moment in time. And they would then donate those shares to a charity, which they would receive a charitable tax donation from. Then the charity would own those shares. And then the charity would be, who is not in the business of investing, they would typically be looking to liquidate those shares in order to fund their charitable operations. So then they would sell the shares to what is referred to as a liquidity provider. And that's typically a sophisticated institutional investor who would be interested in the investment merit of the common shares of the junior mining company, for example. And so to recap, in a traditional flow-through share financing, you have the issuer selling shares to the investor, and that's the heart of the totality of the transaction. In a charitable flow-through, the principal business corporation sells to the initial investor, who then donates to charity. The charity then sells to the liquidity provider or institutional investor who is a long-term holder or longer-term holder of the shares of the principal business corporation.
These attractive structures that you've described, the benefits that they bring, are meant to address a funding gap in early stage resource exploration. Um, why can't traditional funding channels adequately support these projects?
Well, the the resource industry, particularly, let's talk about the mining industry, for example, um, has an early stage funding gap due to the nature of the business cycle from going from exploration to development. And I want to make reference to a particular June 2023 study that was published by a company called S&P Global Market Intelligence. And this study that was published looked at all of the mines in the world that went into production between 2002 and 2023. And they found that during that period of time, there was 127 new mines that went into production in 23 different countries. And and so and when they looked at this real world progress of going from discovery to production, they found that on average it took 15.7 years for a company to go from discovering a mineral property to having actual production and revenue from that mine. And it wasn't the same for all types of minerals. Some of the precious metals were a little bit faster. The base metals were a little bit longer. Some of the critical minerals were even longer. For example, nickel was the longest, took 17 and a half years, with a range of between 11 or 29 years to go from exploration to production. So this funding gap exists because when you have a company that needs to fund its operations, spend likely millions of dollars drilling holes, getting assay results, and developing a geological model for a mineral property, then to only be also required to spend millions or billions to bring a mine into being ready for production and processing. This is a rare investor who has that such long-term patient investing appetite in a very risky asset. And so that funding gap exists due to the nature of that business cycle, in that the lead time and the cash flow model of cash going out the door for well over a decade into decades before cash flows come in the door from the revenue from selling things from your mine, uh, causes that there is a funding gap that's a challenge. But certainly the world needs minerals. This is the start of supply chains. If you don't grow it, you probably mine it. And so having a vibrant upstream mining industry and sector is very important throughout the entire economy. So this funding gap exists, and Canada recognizes that, there's certainly a reason that incentives like flow through shares have their place and have helped Canada become a mining leader in the world.
Over the past year or so, how much capital was raised through flow through shares um, in Canada? And how significant is that to our mining financial landscape?
Well, according to some information that's been published by the TMX, which is the owner of the Toronto Stock Exchange and the TSX Venture Exchange, they've published their 2024 data, which shows that Canadian $1 billion was raised in the mining sector from equity financings related to flow through shares. And that was about 10% of all of the mining equity financing that was raised, but 80% of the exploration funding for projects in Canada. And so it's the flow through share regime is a very significant regime within Canada for exploration and development activities, getting funding within Canada. And of that 1 billion that was raised in 2024, the majority of that was through the charity flow through method rather than the direct method.
Mhm. And if we look at the trends over the past 5 years, would you describe the issuance of flow through shares, standard and charitable, stable or declining?
Well, flow through shares aren't new, and they've been around for many decades. And so you can actually look back for quite a while. And what you see is that the mining industry is cyclical. And when the industry is in more prosperous times, then investor uh, appetite for flow through shares is higher, and also the appetite for issuing them by issuers is better. So in recent times, in the last 5 years, there currently is this rising trend in the issuance of flow through shares because the industry is at a point where there's rising commodity prices. There is rising demand for materials. There is a concern about the security of supply. There's risk of supply chain disruptions, all with the political circumstances that are happening around the world and the uncertainty that comes with all of that. And so right now the trend for flow through shares and mining finance generally are both positive and growing.
Are there measurable outcomes, uh, like exploration activity? And you mentioned economic impact, um, that clearly demonstrate a value for these flow through shares.
Well, I wish it was as easy to say that there's some alternate universe that we could compare Canada with flow through shares and Canada without flow through shares. And as I said, they've been going for many decades. So that alternate universe doesn't exist. But I want to go back to you'd think, oh, where would one find this data? And you'd think that maybe this is going to show up in that same S&P Global study that I mentioned earlier, because the theory would be, oh, with better access to capital, maybe it shows up empirically in the time it takes to develop a mine in Canada. Because what causes delays in going from exploration to development in the mining sector? Usually those delays are caused by access to capital, don't have enough money to do the drilling, or the delays are related to permitting, either permitting for environmental matters or dealing with the necessary First Nations rights. And so you'd think, okay, let's go check this S&P Global study to see how Canada did relative to the 23 other countries that had new mines come into production between 2002 and 2023. Actually, Canada did fare less well than the average country in the world. They found that 11 mines came into production between 2002 and 2023, taking an average of 17.9 years as compared to the global average of 15.7 years. And so you'd think, oh, well, maybe you shrug your shoulders. Are flow through shares doing anything then to assist in getting um, uh, that mines into production and companies through the stages of exploration into development and then revenues by producing? And um, I think that it's clear to say that access to capital with the flow through share regime is beneficial to Canadians and companies seeking to do um, exploration work in Canada, because access to capital is certainly an impediment, and Canada has an advantage. Why it's not showing up in the S&P Global study is because there's still, or Canada has a permitting regime that is taking longer than many other countries, and that's why it's not showing up in a study like that. So now, if we could uh, um, improve the permitting, not by lowering our standards, but find a way to improve environmental and First Nations consultations in a positive way that's beneficial for all stakeholders. And I think we would be in a situation where we have the best of both worlds: access to capital and a streamlined permitting environment. And you'd see Canada perform much better in studies like that.
Um, Thank you, Geoff. Is it fair to say that with the growing focus on critical minerals and rare earths, and our federal government has certainly been part of that growing focus and has been vocal about a critical mineral strategy, that flow through shares fit well into that focus and strategy?
They do fit well into that strategy. Canada is a very large place. We have a lot of critical minerals. We have a lot of rare earths. Rare earths aren't rare because they are rare in the Earth's crust. They're rare because it's very hard to produce them and separate them commercially. And so the government has recognized that these things that are critical minerals are critical because they have a specific supply chain vulnerability and are important in 21st century technology industries and products that makes them critical to the economy and society. And so they have given some additional incentives related to critical minerals. Um, for example, in the initial purchasers of flow-through shares, if those expenses are related to critical minerals, the federal government will also let the purchasers, if they are individuals, also claim a 30% income tax credit on the flow-through share mining expenses that they're deducting if those exploration expenses are incurred for exploration and development activities involving critical minerals.
Um, So you've touched on certain challenges, like permitting, and tax policies. Could we hone in on aspects of either current or proposed tax policies that either are really reducing the effectiveness of flow through shares, or where you see that changes would make a significant improvement?
Well, thanks for that question because it actually hits an interesting point that in January of 2025, I co-authored a publication seeking law reform in regard to policies directly related to flow-through shares and ways to improve the system that would make it beneficial for issuers and investors and be consistent with the Canadian provincial securities law regulations and regime. And so what was proposed in our January 2025 publication related to how expenses are categorized and qualify as Canadian exploration expenses. So currently, in order to qualify as an exploration expense, the expense has to meet what's called the Canadian Exploration Expense Purpose Test. And and currently, a mining company's expense is related to the collection of data and the preparation of key milestone reports, such as a mineral resource estimate, a preliminary economic assessment, a pre-feasibility study, or a feasibility study, do not qualify as under the purpose test to be renounceable under the flow through share regime. However, these are the critical reports and milestones that a company has to go through in order to go from exploring their property initially and then quantifying and proving through scientific and technical information and data that mines are worthy of being built and that it's feasible to do so and profitable to do so. So these are reports and steps that have enhanced disclosure and reduce the risk of the development of mineral property, and they're required by provincial securities legislation to be disclosed as technical reports, but they don't meet the CE purpose test. And so the reform that we're calling for is that the preparation of these reports, which is highly linked to access to capital and financing, that they too would qualify under the purpose test.
Excellent. Um, we, you mentioned Canada's place relative uh, to other countries internationally, and explained some reasons for that. Um, how would you compare the incentives that we provide for resource um, with the incentives that are provided in other common law jurisdictions that we're often compared to, and that's namely either Australia, the US, or the UK?
Well, Canada is the only country that I'm aware of that offers flow-through shares and that type of regime. But the other countries you mentioned, they all also have types of incentives for the mining and natural resource sectors. The United States has an incentive program called the Percentage Depletion Allowance. But it doesn't target early stage and grassroots, and it doesn't target exploration and development as much as it does benefit producing companies by giving them an extra tax deduction related to the depletion of their mineral resources. So this comes
Mhm.
very late in the life cycle, where the Canadian flow-through regime with its focus on exploration expenses and development expenses very much focuses the beginning. In the United Kingdom, there is an incentive called an enterprise investment scheme, um, but it is limited to a tax incentive regime for investing in private companies, so very early stage. And again, is very dissimilar to the Canadian regime, where most flow-through shares are certainly issued by companies listed on a stock exchange. In Australia, they have a program called the Junior Minerals Exploration Incentive, and it's a tax credit that an investor is able to receive, and it's limited to greenfield only exploration, so not brownfield or other later stage exploration and development. And so that's how some other countries are handling incentives and using their tax codes in order to provide incentives to the mineral industry. But certainly, I think the Canadian flow through regime is is better in a lot of ways than these other ones. Although, as I mentioned, there's still room for improvement.
Oh, this has been very helpful, Geoff. Before we wrap up, all in, what would you say are the most common misconceptions or misunderstood aspects of flow through shares?
Well, I think that what is often misunderstood is that people from who are not familiar with the industry and not familiar with the tax regime surrounding the industry is that they don't know what these are, that they've heard of common shares, they've heard of preferred shares, they've invested in these things before, but they don't recognize that flow through shares are just common shares. And so surprisingly, that is one of the initial misconceptions that people have, is that they think they've got some different animal in the zoo than they're typically used to investing in, not recognizing that it's the same common shares that they've known and had before, but from a mining company that's able to renounce expenses. And I think another misconception is that they believe the regime is complex and that it'll be difficult when filing their income tax returns, or they're not used to it. But certainly, tax preparation and advisors and accountants who assist with this, it's very routine and very easy to process on one's tax return. So there's less filing complexity than many people think. But by not being sure exactly of what these shares are or how it may complicate their tax returns, they may shy away. But only if that's the misconception that I think that is most common.
Well, Geoff, thank you very much. Very, very helpful insights in guiding us through this important sector of Canadian finance. Thank you.
Okay, thank you. It's a pleasure to be with you today. Thanks.